At Ground Truth, we take the money strategies your feed sells the hardest, and we test whether they actually work, for real, on decades of real data. Today, it's the one that sounds like a cheat code: velocity banking. Stop spending your paycheck, invest all of it, and pay your bills with borrowed money instead, so $1 does 2 jobs at once. So, we ran it. $88,000 of real paychecks, everyone invested, every bill paid on real margin, on real fund prices, from 2022 through 2026. Then we stress tested it through reconstructions of the crashes of 2008, 2020, and 2022, and forward ran it 500 separate 10-year futures so that no single lucky decade gets to vouch for it. And here's the shape of what came back. That second job your money supposedly works, it pays about a penny on the dollar. 1% a year at the very most, and that's measured back when borrowing was cheap and the market ran nearly straight up. And to make it pay any more than that, you have to borrow so much that a normal market drop takes the whole thing, your portfolio, sold at the bottom, a penny of upside, your entire account as the downside. So, 3 questions, and keep them. 1. Is any of this real? Does paying your bills with borrowed money so your paycheck can stay invested actually put your money to work twice? 2. If it's real, is it big enough to matter, or is it a rounding error? 3. What's the catch? What happens when the market drops while you're doing it? Answer those 3, and you've answered the only one that matters to you: should you run this or buy the course that teaches it? This is the audit of velocity banking. This is Ground Truth. Quick note: this is education and entertainment, not advice. We test ideas. We don't tell you what to do with your money. Start with the pitch, at full volume. The strongest version of an idea is the only one worth testing. Broke people spend their paycheck. Rich people invest it, all of it, and pay their bills with the bank's money. Your cash never stops working. It's earning over here while it's paying your rent over there. That's velocity. $1, 2 jobs. It's how the wealthy get wealthier while you're still paying for everything, the slow way. Slow down, because this only works if you can see the actual moving parts, and there are exactly 2. Gear 1. Instead of paying a bill with cash, you pay it with borrowed money, a line of credit, or a margin loan against your investments, so your paycheck can go into the market instead. That's a float. Your bills ride on borrowed money for a few weeks until you pay the loan back down. Gear 2. Because you're now holding investments and a loan at the same time, you're using leverage. Your money is controlling more than you actually have, like putting a third down on a house and feeling the whole price move. Float and leverage. Every version of this is those same 2 gears: the credit card one, the one against your house, the margin one we tested. And here's the honest part: both gears are real. Borrowing to invest genuinely amplifies your returns. When your investments earn more than the loan costs, leverage multiplies the gap. That's not a trick, it's arithmetic. So the question was, never, is the math fake? It isn't. It's the question the pitch never runs, the one the thumbnail never shows you. Once you put real numbers on both gears, how much does that second job actually pay? And what does it cost you when the market turns? We tried the literal pitch first: invest the entire paycheck, pay every bill on borrowed money. On a normal starting balance, it doesn't even survive the calm years. Covering all your bills on borrowed money from a small account means borrowing more every month than the account can back. The borrowing climbs to 2, then 3 times what you actually own, and the broker force sells you inside about a year and a half in a rising market with nothing going wrong. So the real version, the one a careful person actually runs, caps the borrowing and only floats a slice. That's the version worth testing. And to test it, we didn't argue on a whiteboard, we built the lab. We took the real income funds these sleeves actually buy, with their real prices and real payouts, from 2022 through 2026. Some pay a modest yield and hold their value. Others pay an eye-watering yield and quietly burn your principal to nothing. Which funds are any good is a separate question for another day. Today we're only testing the velocity trick, so we ran the careful, anchor-heavy version. We paid the bills at the real interest rates 2 big brokers actually charge. And because none of these funds has ever lived through a real crash, we rebuilt them through 2008, 2020, and 2022 from the market indexes underneath them, reconstructed, and labeled as reconstructed every time it's on screen. Then we turned the machine on, and the first answer came back fast. Test 1. Is there anything real here at all? And the answer is yes, for a reason that has nothing to do with any particular fund. Borrow money at 5%, put it into something that earns 9, and you keep the 4-point difference on the borrowed money. That's real. That's leverage doing exactly what it promises. And the float is real too. Every dollar of bills you carry on borrowed money for a few weeks is a dollar of yours that stays invested. So write down the honest answer to question 1. Yes, there is a real mechanism here. The people doing this aren't imagining it, which is exactly why the next number is the whole story. Test 2. Put real numbers on it. We ran the careful version, capped borrowing, the steady anchor funds, for 22 months and set it beside the exact same money in the exact same funds with none of the velocity, no borrowing, no bill routing, just buy and hold. The difference, everything the whole elaborate setup bought you, was 0.3 to 0.8% a year, below even that penny on the dollar. And the math caps the theoretical best at about 1.3% a year, barely more than a penny, and only if everything breaks right. And it gets thinner the bigger and the longer you run it. Stretch it from 2 years to a full decade, with every crash put back in, on a portfolio that grows past $1 million, and the whole velocity machine adds about $9,000, not a year, total, over 10 years. That's the entire prize for a decade of borrowing against your savings. A rounding error dressed up as an engine. But here's what ends it. Remember the one gear that's genuinely real, the float, carrying your bills on borrowed money for a few weeks? There's a tool that does that exact float, except it charges you nothing and usually pays you to do it. It's a rewards credit card. The elaborate margin version on a $10,000 account earns you maybe $100 a year, taxed at interest, with your portfolio on the line. A card does the same float for free. The money's borrowed at zero for the month, and there's cash back on top, which is just owning a rewards card, nothing to do with any of this. So, the one real trick in velocity banking you can already do with the card in your pocket, better and without the risk. So, answer to question 2. No, it's real, and it's a rounding error, and the good part you already own. Okay, fine, a penny on a small safe account, but that's because you're playing scared. Crank the leverage up and the returns get real. That's the strategy. He's right about one thing. More borrowing does mean more return when it works, so we asked the machine exactly how much more, and exactly what it costs. That was the good news. Here's the catch. To make velocity banking pay more than a penny, the versions that chase bigger returns all reach for the same lever, more leverage. The popular rule is, never let your equity drop below half. Equity just means the part of the account you actually own, which is a polite way of saying, borrow $1 for every dollar you have. 2 times leverage. And here's the piece the whiteboard never shows you. Your investments are the collateral for that loan. When they fall far enough, the broker sells them out from under you to get its money back. You don't get a vote, and it happens at the worst possible moment, at the bottom. So we asked the machine, at 2 times, on these funds, how far does the market have to drop to trick that? 23%. A 23% drop and you're forced sold. To put that in scale, in 2022, the whole market fell 25% and tech stocks fell a third, so this gets liquidated before the market even falls as far as it did 2 years ago. And 2022 wasn't even a real crash. Then we ran the forward test on that same 2-time setup for someone living off the account in retirement, 500 10-year futures. It didn't get called sometimes. Every single path, 100% of them, was wiped out inside 10 years. Now, there is a safe amount of leverage, and we found its exact edge. Keep it to about 1 1/3 times what you own, not 2, and a portfolio like this survives a crash the size of 2008, a 62% drop, without a call. But that safety has a hidden string. It only holds while a paycheck is covering your bills. In our reconstructed crashes, the still working person, paycheck quietly paying the loan back down every month, survived all 3. The retired person, living off the same account with no paycheck coming in, got called in the 2008 reconstruction even at the safe 1 1/3. The moment the paycheck stops, the seatbelt unbuckles. So, answer to question 3, the catch is a margin call, and the exact leverage that makes velocity banking worth doing is the leverage that ruins you. So keep the 3 questions. 1. Is any of this real? Does paying your bills with borrowed money so your paycheck can stay invested actually put your money to work twice? 2. If it's real, is it big enough to matter, or is it a rounding error? 3. What's the catch? What happens when the market drops while you're doing it? Hold all 3 answers at once, because they're really one shape. On one side, everything the machine earns you, a sliver, a penny on the dollar, at the very most. On the other, the moment you borrow enough to make that penny matter, a normal drop takes the whole account. Same strategy, same money, the upside is a rounding error, and the downside is your entire portfolio. That's not 2 findings, it's 1. And here's why it can't be rescued, why no better fund and no clever version fixes it. For velocity banking to actually build wealth, you'd need to borrow at 5% and reliably earn a lot more than that, safely, through good markets and bad. Stop and listen to what that is. That's free money, a sure thing that pays more than it costs. And a sure thing that pays more than it costs doesn't just sit around undiscovered. We checked the calmest, safest things you could borrow against. Short-term treasuries pay less than the margin costs. Safe bond funds, less than the margin costs. The only things that clear the bar are the ones that crash exactly when the loan gets called. It isn't that velocity banking has a bad version. It's that a safe, reliable edge over your own borrowing cost would be a free lunch, and there isn't one. Leverage can only ever multiply an edge you already have. It cannot manufacture one. We wrote the pass mark down first to be worth the risk. The velocity machine had to add real, durable wealth, meaningfully more than a plain, boring portfolio, and it had to survive a crash. It did neither. In the friendliest conditions there were, the cheapest borrowing in years, a market that ran nearly straight up. It added a penny on the dollar. Scaled up enough to matter, it was force sold in a drop smaller than 2022. That first part, the penny, is measured in real prices. The crash part is reconstructed, and we label it so, and a real crash would only be worse for the borrower, never better. So why does it spread? Not because anyone's lying, and that's exactly what makes it durable. The math is real: borrow cheap, earn more, keep the difference. In a long stretch of rising prices, you can watch it work, month after month, and feel like you found a cheat code. But the difference is thin. The leverage that makes it feel worthwhile is the leverage that ruins you, and the person who got margin called in the last crash doesn't post a video about it. So the internet only ever sees it working. And follow the incentives without blaming anyone. 1. A strategy that sounds like a cheat code gets clicks. Spend a little less than you earn does not. 2. The courses sell because the math checks out on a whiteboard, and on a whiteboard, there's never a crash. 3. It's been a rising market for almost the whole time this idea has been popular, so most people teaching it have never been tested by the one thing that breaks it. Wait, so the boring credit card was better than all of this the whole time? And to be fair to the people teaching this, the good market fooled them too. The same trick that hides the losers from you hides them from the seller. You can run this for years and genuinely believe, right up until the crash you never met. So carry one question out the door. For the next money hack your feed sells you, if the trick is real, ask 2 things. How much does it actually pay, and what can it cost you when it's wrong? A penny of upside against your whole account isn't a strategy. It's a bet you didn't know you were making. So, should you run velocity banking, or buy the course that teaches it? Across real fund prices, reconstructed crashes, and 500 simulated futures with the pass mark set first, no. Not because the math is fake, it isn't, but because the real thing it earns is a penny on the dollar, and the only way to make that bigger is to hand a lender the keys to your portfolio right before the market takes it. But here's what we keep from the wreckage, because it isn't nothing. If you like these income funds, holding a small, careful amount of leverage, about 1 1/3 times what you own, never 2, is genuinely safe as long as a paycheck is covering your bills. Just don't confuse safe with rich. It's a garnish, not an engine, and you have to take the borrowing back off before you retire and the paycheck stops. And the one genuinely useful trick in the whole strategy, floating your bills for a few weeks so your cash stays invested, you already own, in the rewards card in your pocket, working better and for free. And what would change our mind? One thing, a safe place to earn more than it costs to borrow, reliably, through a real crash, not just a good market. Find us that, and there's no trick needed. That's just free money, and we'll be the first to run it through the machine. The day it exists, you'll hear it here first. This is ground truth. We take the promise your feed sells the hardest, and we test it the way a desk would. Real prices, real interest, real crashes, the pass mark written down before the data. And we show the work, because a verdict you can't check is just another opinion. That strategy on your feed right now, the one that turns your paycheck into a machine that works while you sleep, now you know what to ask it.